Whenever you sell products to customers, there's always going to be a chance that the customer is dissatisfied and is going to want their money back. In the accounting world, we call this either a sales return or an allowance. A sales return is when a customer sends a product back to you and requests a refund of the amount paid. This might happen because the product is dysfunctional or broken in some way, or maybe they're just dissatisfied with it. An allowance is similar to a return in that the customer requests a refund, but with an allowance, the customer isn't expected to return the product. They just get their money back. It may seem strange to give a customer their money back and let them keep the product, but it happens all the time in some industries, like the food industry, for example. Imagine you get a soda from a vending machine, and the soda tastes funny. Most companies will refund you your money if you are dissatisfied with the product, but they won't ask you to mail in that half-empty can of soda. That'd just be weird. Sometimes overseas companies also use allowances because the cost to ship the product back, especially if it's damaged and would just be thrown away anyway, is more than the product is worth, and the company doesn't want to waste that money. In both situations, either a sales return or an allowance, the refund to the customer is recorded exactly the same. The only difference in accounting between these two scenarios is that you record the return of product for a sales return and you don't for an allowance. Whenever you refund money to a customer for a return or an allowance, you would need to credit cash for the cash out to the customer. But where would the debit go? We are essentially refunding the customer's sales back to them. But we don't want to debit sales directly. Just like with sales discounts, debiting sales directly would lose the ability to report on how many refunds we are giving out. That's pretty important information to keep track of. So instead, we would debit a special account called Sales Returns and Allowances. The Sales Returns and Allowances account is part of the revenue category, but it does have a debit normal balance instead of the usual credit. This makes Sales Returns and Allowances a contra revenue account, just like sales discounts. Remember, it's called a contra account because it has an opposite normal balance as the rest of the revenue category, so it will always have a negative balance. So let's imagine that we give a customer a sales allowance for $1,000 of product that they paid for in cash, but were lost in shipping. To journalize this transaction, we would debit sales returns and allowances for $1,000 and credit cash for the same amount. Then, on the income statement, this allowance would appear in the revenue section in the sales returns and allowances contra account below sales like this. By splitting the allowance into its own account, we can see that there were originally $34,000 in sales and $1,000 returned to the customer. So our net sales are only $33,000. Now, what if the customer ordered these products on account instead of paying for them in cash, and they haven't paid off their accounts receivable balance yet? In that case, the journal entry would be the same, but instead of crediting cash, we would credit the accounts receivable to indicate that the customer no longer needs to pay for that amount. To learn more about returns and allowances and other contra accounts, check out more of my videos on YouTube or visit ToriNorman.com.